Welcome to our High Rock monthly video for September. Today we should look at how financial markets performed last month and what implications this has for your portfolios in the near term. We will update you on any key adjustments to our models and special mandates and how the way that we manage risk first will be the key to maintaining growth in uncertain times. I am Scott Tomlinson, and with me on the call today is Paul Tepsich, founded High Rock in 2010. We started our private client wealth management division in 2015, and we celebrated our 10-year anniversary in April. If you are interested in learning more about us, visit our website at www.highrockcapital.ca. Well, let's start with a recap of August. Paul, gold and silver, I know you're going to talk about them a little bit more later, but they seem to be the best performers over the course of the month of August, followed by both Canadian and international equity, which left U.S. equity kind of trailing. And because U.S. equity makes up about half of global equity, that pulled global equity lower. Balanced portfolios, as usual, right in the middle, up a little over 1% on average. And Canadian bonds, Canadian preferred shares, basically flat on the month. I don't know if you've got any additional comments, Paul, but feel free to chime in.
What? Yeah, thanks, Scott. Let me just save a couple comments for the tactical model with regards to gold and silver, because that is obviously, as per this chart, the highlight.
Yeah. Okay, perfect. So let's just focus a little bit more on balanced mandates. On average, the thousands of funds measured by Morningstar, who we use for comparative purposes, were higher on the month and up about 5.5% year to date. We also want to encourage our clients to check their performance against this to see how well they're doing. And as always, if you have any questions, we want to make sure that you come to us so that we can have that conversation. Growth has been a little slower this year. Certainly a lot of volatility at the beginning of the year. Most of that has been taken back out of the market, but it is always important to understand what volatility does to a portfolio. We look at a 5-year standard deviation from the mean, one standard deviation from the mean, and that on average is around 8%. But when you look at the return you get relative to the risk, on average, Morningstar says you're getting about 0.75%. Most of High Rock clients, if you check your portfolios, get closer to 1%. So that's just us being a little bit more astute with regards to the management of risk, and that's what we do. We manage risk first in order to get the best possible returns that we can for that risk. And something that I showed last week, but I'm happy to show again this week, is how that does compare, how volatility does impact the portfolio. Certainly earlier in the year, it was a clear example of how a more equity-oriented portfolio suffered significantly in April and into May, where balanced portfolios with less correlated or non-correlated assets perform much better. And the key to that always is that the balanced portfolios get back to growth more quickly, and it takes the equity portfolio a lot longer to catch up to where it had been. And we continue to monitor that at all times. I created a short video on our website that does dig a little deeper into that. Investment Risk 1. You can go to the High Rock website under media, under videos, and you can find it there if you want a little bit more information. And of course, we're always here to answer your questions if you have any with regards to how your portfolio has been performing in general. We always are available to discuss longer-term strategy. It's very important that we maintain a focus on your long-term goals. And so that is also another reason why we do need to continually meet and update and monitor how your lives are moving forward. Let's talk quickly about the economy, Paul, because today we had a couple of key data points, both from in Canada, employment declining through August by 66,000, which was significantly more than expected, and pushing the unemployment rate up to 7.1%. Now, that is going to be a big factor going forward because Canadian household is pretty much coming to a tipping point as there are still somewhat in the vicinity of 600 billion in mortgages that have to be renewed, and a lot of those mortgages were originally locked in the low interest rate COVID period, and interest rates now for a 5-year mortgage are about 4 percentage points higher. So there's going to be a significant impact on the consumer and on the household as we progress forward. And that also being said, the housing market's not doing so terrifically well, and exacerbated even more is the condo market, especially in Toronto. Paul, I don't know if you have any comments on that, but I think it's important to be cognizant of the multiple factors that are hitting the Canadian economy at the moment.
Yeah, that's true. And not, I mean, the US is in a much different situation. Well, not much different. It's in a bit of a different situation, but I think the 30,000-foot dynamic is the same, which is to say that it's a battle between monetary policy being tight and perhaps now we're seeing by this slide a need to perhaps become a little bit easier. Yet the fiscal situations in both countries are shockingly bad and getting worse, and that transfers all the way across the Atlantic through Europe, the UK, etc., and into Japan. I mean, Japan's in a horrific way. So that would bring us to our next discussion, perhaps when we get into the tactical model about gold and silver. But yeah, I would imagine here that both the bank and the Fed meet on the 17th in 2 weeks' time or so, and I would think that they both go 25, but then they go again in at their next meeting, certainly before the end of the year. So that's inflationary ultimately, and that along with the fiscal situation being so stimulative that's why gold and silver are moving higher.
Yeah, good point. Okay, so very quickly, in the global equity strategy, we are in a bit of a holding pattern. Markets being at their highs, valuations being stretched, and greed coming back from the fear of what we witnessed in April when we were doing buying. Now we're rebalancing, and as we rebalance, we're balancing back to being a little light in the global equity model for clients. Everybody's portfolio will be somewhat different, just depending on your cash flow needs. But again, if you ever have a question about how we're doing that, I obviously want to have that conversation. But at the moment, we're not putting our buying hats on with equity markets where they are, and thinking that they're slightly overpriced at least. Paul, do you want to talk about the tactical strategy now?
Yeah. So as I was mentioning, I think the number one thing to talk about here is gold and silver. So gold, we do own physical gold, which is held at the Royal Canadian Mint, and that is represented here in this chart by CEF. It is a fund as well, and about 60% of it, or 62 or something like that, is in physical gold, and the other 38% or so is in physical silver, both held at the Royal Canadian Mint. It's important to know when I say physical silver, because you can buy exposure to gold, but it may come in paper format, i.e., it's effectively it's not physical that you own. It's a product based on gold, and I think that's very dangerous. and same with silver. Now the question is like, why are these both going up the way they have? Why did we own them? Because uh, these both Canada and the U.S. and, as I said, across the Atlantic into Europe and the U.K. and Japan, the gig is kind of getting stretched. The elastic band is getting stretched so far on what fiscal policy can do. And I think we would all agree, forget about your political stripes, but these politicians, they're only in power for 4 years, if that. And they promised a lot of things, and fiscal stimulus, all these budget deficits, by votes. And what it does in general, and Milton Friedman, for those that want to go look up his quote, I mean, if you want to look for inflation, you look one place and one place only, and that is government overspending. And that is what's happened. It just seems like it's hitting a stretching point, and there could be, well, there are in certain places, certainly in Japan, the UK has experienced it, and quite frankly, even up until the last couple of days, Canada and the US, a bond buyers strike, i.e., foreign bond buyers, and that could be China, it could be the bank, or pardon me, the post office in Japan is a huge holder of U.S. Treasuries. They pull back and say, well, wait a second here. You know, all this fiscal stimulus is creating inflation, and we're having our purchasing power eroded. What it does do, and we see it in the stock market, is it creates what I would call hyper asset price inflation. That's what we've seen over the past 5 years of COVID, where this fiscal stimulus and the monetary stimulus that worked in concert with it, quite frankly, up until a few years ago when the central banks were tightening monetary policy or raising rates, all that fiscal stimulus went into assets. So sure, we saw some consumer price inflation through food and building products, et cetera. But where we really saw inflation was in asset prices. So those with assets did pretty well. If you had an investment portfolio, it went up. That's where all the stimulus went to. It went into housing, and it went into even used cars or new cars. So, however, the things still get stretched. Like Scott, you mentioned the housing market in Canada. I mean, the condo market, I think, is, I don't know if I call it in free fall, but it is certainly declining. And it's a difficult sell at this point because of, I think we're in a situation where we've got oversupply of condos, believe it or not, as well as we've got an affordability crisis. So even these hyper asset price, the pardon me, the assets that have been inflated the last 5 years, they can still run into problems, like the real estate market in Canada, or certainly in Toronto and perhaps Vancouver. So that's not to say the stock market's going to keep going up forever and ever. It too can be stretched, which I think you would agree with, Scott. So that's why we own gold and silver. They are a stability mechanism, a store of value. They hold value, and to be honest, Bitcoin is very similar in many ways. Although not physical, it's still it exists for the same reason as gold and silver and perhaps some other metals. Okay, I waxed on long enough.
Talk a little bit about fixed income. I know you mentioned that bonds are being reviewed, especially what has been considered the safest bonds, which are government bonds. So, obviously, with weaker economic data today, bond prices are a little higher, but they've been lagging a lot.
Yeah. Yeah, I'll just start off by saying in the fixed income model, that pie chart, pretty much everything added value to our portfolios, all those different subclasses in the fixed income. Preferred shares, as you shown earlier in one of the charts, were pretty much flat. And the two preps we own are fixed rate in two of the three fixed rates, so they actually improved to SNC. Yeah, well, I think what I would add here with regards, going back to the longer discussion I just gave, which was perhaps too long, is that we never considered government bonds to be credit risk, but I think we have to start looking at that right now. And I think that's what we've seen. So why have investment grade corporate bond spreads and high yield bond spreads compressed down so much on top of government bonds, both Government of Canada and US Treasury bond yields? It's because they're, quite frankly, they're in many cases better credit risks than the US government or the Canadian government. So if I look at, um, you could look at different fiscal metrics, but heck, and you know, I've written this the last few months in our high yield monthly update, but I'd rather own a Canadian energy bond that has effectively zero leverage on it, so effectively no net debt free, and they cover their interest by 10, 15 times through cash flow. That's like phenomenal credit. So, you know, whereas the government bond yields, A, they're lower, and B, they're wickedly volatile, far more volatile than an oil bond, oil or gas bond in Canada. So that's that's my view on when people start talking about, wow, credit spreads are pretty tight. So yeah, there's a reason why. Some of these corporates are in phenomenal, they have phenomenal balance sheets. That's it, Scott.
Okay, great. Thanks, Paul. Anything to add with regards to our special mandates?
I might have just done that. Certainly on the high yield side,
Yep.
ticking along with what we call the good coupon year so far. I mean, 7 or 8 months into it, um, and we have a very high energy weight, and we have for more than 5 years. Um, so that's that for high yield and preferred shares. Obviously, have done extremely well since inception and even year to date. Now we do have to keep in mind that you know, I think they're getting close to fair value. We have taken quite a few profits and are sitting on a pretty big cash weighting in that mandate now, Scott.
Yep.
We just had another bond that will be redeemed at the end of September. Fairfax, uh, not bond, pardon me, a Fairfax preferred share. They redeemed two of them at the end of September. So we're going to go up even more. We'll be up, you know, upwards of 35+% cash weight. So we're in a fairly defensive mode there, which I'm pretty happy about. I want to see how this plays out here with rate cuts and how the back end of the 30-year yields respond to those front end rate cuts.
Got it. Well, thank you for that. All right, that's it, folks. As always, we want to thank you for taking the time out of your busy schedules to join us on this call. We will be back with our next update at the beginning of October. So until then, on behalf of my colleagues, Paul and Diane, we want to wish you all the very best.